All right, folks, welcome to volume 1 of 3 for Mastering High Probability Scalping. Now, this is a video that's going to be kept on my YouTube channel, and generally anything that's predominantly linked to just my YouTube channel will have this intro. And I'm going to ask you as the trading community to help me out. A lot of times folks will take my content and re-upload it on their own YouTube channel. And if you see that, just let me know, and I'd like to be able to have that taken down. I put the work into these presentations, so I'd like to be able to get the credit and the benefit of ad revenue off of it. So if you see it, just let me know, and I appreciate it. You don't have to be public about it. You can send me an email at innercircletrader@gmail.com. I greatly appreciate it. Thanks. All right, so before we begin, I'm going to ask you a question. What is high probability scalps? Every one of us would have a different definition, I'm certain of it. But for me, as ICT, it's 10 to 30 pip price swings. Now, I don't do a lot of this type of trading. It's only recently because I've come back online, and it gives me an opportunity to give a lot of setups, a lot of results, a lot of things to study. I guess it's probably one of the easiest things to get people excited, and I know that going in, and that's the reason why I adopted this style of showcasing my talents. But I don't want you to think this is the only way you can trade the markets, because it's not. There's certainly ways you can do it from an end of day standpoint, but I want you to know that what I teach has consistency, and it also has the ability to prove right away that the markets are not, in fact, random at all. They're very, very organized. They're very specific about where they're trying to get to intraday and even on a weekly basis. And I would probably argue the point on an even longer term basis, but I just haven't made my precision that long term yet. I don't think I ever will. Personally, it's not my cup of tea. I like day trading and short term trading. One shot, one kill is what I'm known for, which is trading the weekly range. So daily highs and lows are my specialty, and weekly highs and lows are my specialty. So I try to trade inside those ranges, and I get the meat, or hopefully the meat of the move. I'm not trying to get the very high or the very low, but I know where those parameters are, and as long as I haven't met those extremes, I know I have opportunity, or life in the battery, if you will. All right, so we're going to be focused on specific things in this presentation. It's not going to be very long. I want to keep them concise and short, and again, it's 3 volumes. So if any questions come up by while you're watching this, it's important that every time you watch any of my videos, have a notepad in hand, turn the radio off, go into a quiet room, listen to what I'm saying, because I'm packing 20 plus years of information and experience in very, very small bandwidth. So just write down your questions. I'm quite certain that you're going to be able to find the answers to them in future presentations. For this one, we're going to be highlighting the many opportunities in scalping the Forex. I'm going to be teaching you how to learn directional bias for higher time frame institutional sponsorship, and I'll explain what that is when we get to it. And how to determine the highest probable times of the day to trade. And we're going to be learning how to frame high probability setups for runs on liquidity. Sounds pretty fancy, I know. All right, so high probability scalping. Now this is an example of a high probability scalp, and this is in the dollar CAD. Now right away, some of you are going to be watching this video months and years from the time I actually presented it. Trust me, I tweeted live and people watched this actually be shown to them live. Okay, this actually was a weekly high at the time of this presentation, but I was calling a weekly and daily high. Looking at this specific range, everything that's in here is all that is necessary to know how to do short-term scalping intraday. Now, because it's scalping, there's going to be times when these setups overlap with longer-term conditions. Now, I'm not teaching one shot, one kill here. I'm not teaching swing trading or position trading, but I will drop that little nugget for you to study. It's obviously found in my free tutorials. You can find that on my website, theinnercircletrader.com. is a free forum. You can join that. It's absolutely free to get in there, and you can watch all my free tutorials that I'm releasing. And you'll also be able to see some things I share in Trading Journal entry. So that way you can give me an opportunity to speak to you by way of how I interpret and reflect on what has been seen in the marketplace when I take action, or if I take action and I lose, you kind of get a vibe on what it is I've either felt or what I was thinking during the day when I was looking at the marketplace. But a short-term scalp here is a very simple approach to running out previous day's highs or previous day's lows. That's all that it is. We're targeting buy stops above the previous day's high or a day or two ago. In other words, we're always going to be looking back the last 3 days. Okay, there's your range. Okay, you're going to be looking back at the highest high and the lowest low in the last 3 days. Now you're counting today as day one. So for instance, at the time of this recording, the day of the week is Thursday. So we would be looking at Wednesday's data and Tuesday's data. Very easy rules, right? So we know what the daily high and the low is on Tuesday and on Wednesday, and we're monitoring what's going on intraday for today. That would be Thursday at the time of this recording in November 2nd of 2017. Now, what we're aiming for is exactly how bank traders trade. Now, I know a lot of folks on YouTube claim to know certain things and they use a lot of buzzwords, but I'm going to show you something that no one else teaches because they don't know it. Okay, but I'm going to show you in recent weeks, since I've been back on social media, everyone's noticing a tone or a difference in my presentation. It's a lot more concise, a lot more accurate, a lot more specific in nature. And that's because I've spent the last 14 months with people on a day-by-day basis, and I've been able to share with them really openly about what I've learned over the last 24 plus years. And it's not retail. Retail things get you into this business. I'm going to show you how to leave that stuff behind you and think institutionally. That's like my tagline. I want everyone that follows me to leave that retail mindset because it's not going to help you. In fact, it's actually going to be a hindrance or a snare. You're going to find yourself not finding consistency at all. And if you ask yourself right now, are you consistent? And if you're following retail stuff, you're probably not. Using the things I'm going to teach you in this 3 volumes, you will quickly find consistency. Now, I did not say profitability. I cannot promise that. Some of you are going to break the rules. Some of you are going to do things early. Some of you are going to do things late. You're going to risk too much, okay? And you're going to do too many things at one time. That's what's going to cause the adverse effect. And I don't want the credit for your wins, and I don't want the credit for your losses. So be responsible. It's only for informational purposes only. All right, so when we look at high probability scalping, now this is an hourly chart on the dollar CAD. And what I've done is I've highlighted the individual daily highs and lows. Now, it's important that from a scalping standpoint, your time frame you're going to be following mostly is going to be on the daily because it's going to give you a bias, and I'll show you how to do that. It's really simple. But for looking for liquidity, you're going to be using the hourly chart because it gives us a real nice framework to see where previous day's high is or the previous high 2 days ago. Okay. For instance, right now at the time of this recording, right over here, this is Thursday's data in the far right of the chart. Okay, and yesterday's Wednesday's data. You can see the low, it's been highlighted here, and the high, and then Tuesday's high and low. Okay, so I want to draw your attention to the fact that we have traded below Wednesday's low today, and we've also now traded below Tuesday's low. So that to me is a significant point, and I'll talk more about that in volume 2, but I want to kind of like bring your attention to it right now because it's going to be salient to what we see going into tomorrow's trading. Okay, and you'll see all that in hindsight, but I'm drawing your attention to it right now. But each day, daily highs and lows, okay, when it's bullish, when the market is bullish, and I'll show you how to define what's bullish and what's bearish, not requiring any indicators. No trend lines, no moving averages, no oscillators, none of that stuff. Okay, just using purely price action only is all that's necessary. But when we're bullish on price action, we think higher prices are in order. Let's just say we come to that conclusion right away. If we're bullish, an institutional mindset is running liquidity on the previous day or previous days prior to yesterday's high. Okay, and the reason why is there's a lot of speculation about catching highs in the marketplace. Okay, and especially if we have a day that saw a retracement the day before or 2 days ago lower. That means there's going to be built-in positions that are short. Okay, folks that have tried to sell short on the marketplace, they're going to want to try to capitalize on movement lower. Where's their buy stop going to be? Above the most recent high. What's the most recent high? Yesterday or the day before. Now, why am I having you look back 2 days ago and include today's range? Because every swing high on a daily chart and every swing low is comprised and created by 3 individual bars. You have to be monitoring these daily highs and lows because you want to be able to forecast eventually, as I teach you in volume 3, swing highs and swing lows before they actually materialize and start breaking down, because sometimes the markets will turn on a dime and they don't give you the setup that I'm going to outline in this volume 1. But this is the bread and butter easy way approach. It's not going to give you a setup every single trading day, and that's exactly what I want you to avoid trying to trade every single day. Now, there's a reason to trade a demo account every day to practice the setups, but do not try to force your live account into a condition where it must trade every single day. Day trading is not everyday trading. So I want you to take a look at when price has moved higher. Every previous day, its high has been violated. Okay. Generally, folks won't pay attention to that simple phenomenon. It's a very simple approach, but it eluded me the first 6 years of my trading. I didn't see this element to trading until about 6 years into my bond trading. Now, I started as a treasury bond trader and S&P futures trader. Those were my 2 markets of choice. Either I was in SPOOs, which is S&P, or I was trading the treasury market or bonds. I was rarely ever in both because they are basically diametrically opposed. Think of it like the dollar index and a foreign currency. Okay, I didn't do anything else. I didn't trade agriculturals anymore. I just focused on those 2 pairs, or not pairs, but I focused on those 2 markets. Why? Because I didn't need anything else. If you are watching multiple pairs right now, stop. Just do it for 1 month. Humor me for 1 month. I promise you, if you give me 1 month of your time and focusing on one currency pair, and it doesn't have to be one that I suggest, pick one. Any one of the majors that's crossed with the dollar. I promise you, you will learn. You'll learn more by doing that than trying to do all these other things with other different pairs. If you're trading multiple assets and you're now starting to learn Forex, stop trading other asset classes and just focus 1 month with me. Use the information I give you. And again, I guarantee you, you will understand price far better than you ever have before. And it's going to be very simple approaches. So you got me on a guarantee there. So now, if we're bullish, what we want to be thinking about is where price is going to be drawn to. Okay, that's called the draw. Now, when we look for where the market's going to reach for in terms of bullishness, it's the previous day's high or an old high. That's going to be in the form of buy side liquidity or buy stops. So the market will draw up to that level, okay, and dip into that liquidity pool where there's existing buy stops. For instance, if you were selling short, your buy stop would be above the current market price. At what level? Whatever the previous high was. That's what the books tell you, right? So if your stop gets hit, what that becomes is a market order to send a buy order right away in as a market order. So your buy stop transforms into a market order to buy at the market, and the market is going to be driven up there from an algorithmic standpoint. And I'm not going to get into that here, and I'm not trying to convince you of it. Just suspend your disbelief if you don't believe it's algorithmic in terms of how the markets move. Think of it as just, supply and demand if it helps you right now. Okay, but when price goes above an old high, it's going there to force buyers to come in at a higher price. Instead of buying low, okay, they're forcing buyers to buy at a higher price. So smart money has at some point accumulated a position at a lower price, and they're driving price up to formulate an opportunity or condition for participants that have existing orders or real interest at buying at a higher level to be forced into or out of positions. Okay, and that's all this is all basically framed on. Now, I'm framing this whole discussion tonight on the basis of looking for buy side liquidity or buy stops or running out buy side liquidity pools. Okay, so when we're bullish from an institutional standpoint, what we're looking for is the draw. The draw is above where market pricing is now in the form of old highs. Now, we're using for scalping, we're using previous day's high, for a very simple little day trading approach to capture 10 to 30 pips inside of one trading day. Now, every pair out there does this several times a week. Not every day does one singular pair create this condition. So it's important you have that in your notes. Do not anticipate this forming every single trading day in, say, for instance, the euro dollar. Okay. If you don't see a setup in the euro dollar, then once you understand the setup, okay, then you can go into other pairs, like pick 4 majors, okay, and maybe a cross. And that's like your little basket of currencies. And you go through that. I'm not inviting you to go through 28 pairs. Okay. Don't do that. But you can find a setup that I'm going to teach you tonight every single trading day to practice on. If you have learned what's going to be presented to you in the first, the first, second, and third volume completed, once you understand that and you've practiced for at least a month, then you have my permission to go into including 4 majors and a cross and then start looking like that. And you'll see that there's a setup every single trading day. But it's not my invitation or my goal to inspire you to try to trade every single day. Don't do that. My hope is that you learn to find 1 or 2 trades like this per week and then force yourself to be disciplined to not trade anymore. Because every time you trade, you're opening the invitation to lose money. And the closer you get to Friday's close, with a losing position, it's just going to make you miserable over the weekend. And it's nothing worse than having made money in the beginning of the week or sometime during the week and then go in one more time and lose it going into the weekend. It's frustrating. I've done it many, many times over the last 2 decades. You don't want to do that. It's avoidable. Once you make money in your demo account, okay, I'm not promising you making live funds, okay, because I'm not licensed to do that, but I'm teaching you how to practice in a demo account. That's all I'm doing here. If you use this information in a live account, it's on you. Win or lose, 100% of the responsibility is on you, okay? So in this hourly chart, we are looking at 2 time frames, the daily, which gives us our bias, as I'll indicate, and the hourly, which sets up where the market's going to most likely reach for the draw. Okay, that's where the liquidity pool is. So if we're bullish, again, we're looking for an old high to run to. That's it. Very simple strategy, nothing more than that. Okay, so now we're looking at a daily chart. And I want you to look at the patterns I have here because it's going to be very important to understand what these are because it's going to give us the context to define when the market should be bullish and when it should be bearish. Over here in the left-hand corner, this is a swing low, and this is a crude depiction. I didn't add any color because I just want you to think about the overall pattern itself. Now, any one of these 3 candles can be up or down close in nature. In other words, it can be a bullish candle or a bearish candle. All 3 of these, it does not matter, okay? All we're looking for is the generic formation of these 3 candles, okay? One having the lowest low and a higher low to the left and a higher low to the right. It's only 3 candles or 3 bars needed to find this pattern, okay? If you look at MT4, there's a little indicator you can click on. It's called a fractal, and I really wish they would have never named that, and it's a Bill Williams thing. I'm not a fan of Bill Williams material, and I'm not trying to be disrespectful, but what I'm teaching you is what I learned from my mentor, Larry Williams. I think he's proven himself. He's made millions of dollars, and it's documented. You know, he's took 10,000 to over $1 million in 12 months, and you can see that on the Robbins Trading Contest website. You can see no one's even come close to his record. But his approach to teaching market structure starts with this simple concept of a swing high and a swing low. So when we see a swing low, it's 3 bars or 3 candles, okay? Once that forms, what we in the old days would call that would be a ring low, okay? Because we didn't have charts, we had to really just write that down in our notebook. And the lowest of the 3 candles, or the lowest in recent week or the month, we would put a circle around that number, okay, on our little binder. And that's the way it was. It was like that in the old days. So we would know that that was an important low. Why? Because it had a higher low to the right of it and a higher low to the left of it. Okay. So when we see this formation on the daily chart, okay, what we're looking for is this to occur after, and this is important, you need to anticipate this forming after a swing high has been broken. Now I probably just took a huge leap forward and I probably lost a few of you, so let me say it again. We are only really interested in looking for daily swing lows after a swing high, which is a high that has two lower highs on either side of it. Okay. In other words, we've got one daily candle or bar with yesterday or the previous day's high being lower than today's, and then tomorrow's day should have a lower high. Okay, so now this is what we're seeing, a 3-bar pattern. You wait for this to occur in the price action, and if price trades through the swing high, you are now on bullish alert. You wait for the swing low to form. What you have done is you've waited for institutions to get back in line with the momentum on a short-term basis, and the algorithm, once it creates that swing low, again, after the swing high has been broken, momentum is now bullish, and you're waiting for this short-term pattern here. When that happens, your focus is going to go immediately to the high of this number 3 candle. And let me number these candles so that way we can track it and know what we're looking at. So this is for directional bias. These candles now have numbers on them, and it's always moving left to right. Number 1 candle, number 2 candle, number 3 candle. What we're doing is we're watching, once the daily swing low forms, we want to see the high be traded through on day number 4. Okay, once day number 4 does that, we know that day number 5, we can be looking for a run on previous day's high liquidity. You can be aggressive. Once this formation occurs, if we open below number 3's high, say during London or New York, if we're below that low, and if we have a condition that presents an optimal trade entry, you can go long and look for a run on number 3's high for a run on liquidity above number 3's buy stops. That's a little aggressive, and I'll give you rules to do that in volume number 3, but tonight I want to keep it very simple and very, very elementary. So as a recap, what we want to do is we want to see a swing high, this formation form, and we see that here. Okay, we see a swing high. It has a lower high to the left of it, a lower high to the right of it, and we want to see it trade through that high. It does it here, right here on this large wicked candle. When that happens, we start looking for this formation on the daily chart. It happens right here. Okay, we have a long wicked candle, it has a higher low to the left of it, a higher low to the right of it, and the very next day, we want to be looking for runs on previous day's highs. For a resistance of previous day's high, it's going to give them, in the retail world, the false sense of security that the previous day's high is going to stop price, and it's not going to. So we can see how markets that have this condition have a tendency to continuously move higher. Each day, look at how the previous day's high is violated to some degree. Okay, and then when we get these inside days, and I'll talk about that in volume 2, inside days are going to be important, but not so important for the first volume. I just want you to understand the basic premise on how we get the directional bias and why the swing highs and swing lows are important. So each previous day's high is taken to some degree. Every day has a varying amount of pips, and again, I'm not trying to promote the idea of knowing exactly how many pips next week's going to have or 3 days from now. It's not important. There'll be tools and things that you learn in volume 3 to help you get to that. But for now, just be content with learning the general rules of how to determine whether the market is bullish or bearish. If you do this, okay, this is not mentorship level bias, but it is a real quick down and dirty approach, and this is actually how I learned it the first time in terms of finding basically daily momentum. It's all it is, and it doesn't require you to have any kind of momentum indicator to do it. No moving average and none of that stuff. Okay, you can read it just from price. So again, simple rules are we want to see a swing high broken to the upside. Okay, we see it here with this swing high. So now we have momentum on the bullishness, pulls back, wait for a swing low to form. That's this pattern here. And then we start watching number 3's high. Okay, we want to see number 3's high be violated. In this case here, we see it violate right there with this kind of like a indecisive candle. And then the very next day, we see what? It opens, it trades down, and then blasts off through the previous day's high. Now, when you have that type of move, it can happen the following day, and it does. It opens, okay, and trades above the high a little bit. That in itself is a scalp. There's nothing wrong with that little bit of a move, but I want you to focus on finding one good setup. So if we have a move like this, chances are I would probably look at another pair, only because I understand the conditions and I know the setup. So it may have burnt itself out on one pair, especially if it's a big move. If it's just a marginal move, then it'll probably seek follow through on the next day and maybe the next day after that. So we have it again here. It opens, okay, trades down a little bit and goes higher, running out the previous day's high again. And again, that's a trade. That's all it is. It's a scalp. We are not trying to get the weekly low with this. We're not trying to get the daily low and holding to the close. All we're doing is looking for an opportunity to run out a previous day's high or a high from 2 days ago. That's the context. That's the premise behind the system. That's the method. Okay. Why does this work? I'm sure you're probably asking yourself, why does this have any validity to it? When bank level traders are working, they are trying to turn over liquidity, okay? And what I just taught you is the draw, okay? The draw is previous highs and previous lows, referencing daily highs and lows. Banks target those liquidity pools more than anything else in Forex. Don't take my word for it. Go through your charts and you'll see that's exactly what goes on. When you have things that are bearish, okay, we're going to flip the script for a minute. We want to see price trade below a swing low. Once that occurs, then we start waiting for a swing high to form. Why are we doing that? Because we're waiting for a retracement. It's going to go to an overbought condition. We don't need indicators to do that or derive that information. When we have this short-term high here or swing high form, we start watching the daily candle number 3, and we want to see it trade through that low. If it does, we know that we are in bear territory, and we're probably going to see each previous day's low be violated, and that's the setup. That's the condition, okay, and it's seen here. Okay, we see a swing low broken here, and then we wait for a swing high to form. That's here. We have a high with a lower high to the left of it, a lower high to the right of it. We wait for this number 3 candle's low to be taken out. It does it here. So then what we do is we target a run on this candle's low. It opens, trades up, creates a high of the day, and slams down. Okay, that's it. That's the setup. It doesn't have a whole lot of sexiness to it, but I'm telling you right now, it's got a whole lot of consistency to it. And a lot of you probably don't have any consistency whatsoever or what you're looking for. And this is a very easy bread and butter approach. Now, again, I am not trying to package this in a everyday approach for one individual pair. This works in stocks. It works in futures. It works in bonds. It works in just about anything that can trade. So when we have this momentum on a daily chart and we know we're either bullish or bearish, it stays that way until we get a break in opposing market momentum. And I'll give you an example of what that would look like. Here, we have a swing low form, and then price comes down and breaks that swing low. That upsets the momentum. At this point, we have to see a short-term high be broken. Okay, a short-term high has to be broken. And then we have it here. We have a high with a lower high and a lower high to the right of it. It's broken to the upside here. So when we have that, now we go back in the cycle of looking for a swing low. The swing low forms here. We have a candle to the left of it that's higher low, the low in the middle, and the next candle is up. So we want to see price trade through number 3 candles high. It does in fact do it here, and we trade through the next day, running the previous day's high, and it continues that cycle again. Okay, so all we're doing is monitoring a break in the swing highs and swing lows, giving us a bias on the daily chart. Why am I looking for it on the daily chart? Because momentum that begins on the daily chart tends to occur and be lasting for at least a few days. It can be 2 to 5 days in duration. So if we have momentum working one side higher or lower, it tends to stay in that direction for a period of a few days. And that's all you need to have a really good scenario for short-term trading, intraday scalps. So again, in summary, when we're looking for the swing low, this is only being stalked or looked for in price action until we see a short-term swing high being broken. When that happens, then we start looking for this pattern. Okay. For daily swing highs, this only is being hunted or stalked in price action after a swing low has been broken. That gives us a break in market structures, what it's basically giving us a definition of. And then afterwards, there's going to be a retracement. And when we see that retracement occur with a swing high, we know that we can start looking for sells running out previous day's lows. When we see the swing high broken and we find a swing low form later on, we know we can look for candle number 3's highs to be rated and look for the buy stops to be ran out for an intraday scalp. That's a very, very simple approach. It's very easy. And if you're not understanding it, just watch this video again. I promise you, you're probably overcomplicating it. It's not necessary. So I'm going to focus our attention on this little segment of price action here in the shaded area. And we're actually going to walk through on an hourly chart and look at the framework of each one of those respective days and how it targets liquidity runs on previous day's highs. Okay, folks, we're looking at the hourly chart at the beginning of that shaded area that's showed on the daily chart for US CAD. And I want you to just see these lines down here. Okay, these are just delineating the ICT kill zone, and the red area is delineating specifically aiming at around 2 o'clock in the morning to 4 o'clock in the morning, New York time. Everything I say in terms of time, you're going to have to translate that into your local time relative to New York time. Okay, so if I say 2 o'clock in the morning New York time, wherever you're at globally, just get yourself a clock set to New York time and then look at that time in reference to your local time, and you'll be able to decipher what it is you have to do and make the adjustments. I do not want to get into a conversation about time because it's very confusing for me. Admittedly, I've done this many times in the past and erroneously said something and confused a reader or viewer. So it's better for you to just do the work in transferring and converting your local time into New York time. Okay, so London is basically 2 o'clock to 4 o'clock in the morning. That's the sweet spot or the best time to anticipate a higher low to form. And the New York is going to be 7 o'clock in the morning to 10 o'clock in the morning. We'll just give you a nice little window like that. It can be refined and defined in my tutorials, but for now, just for the sake of this method, just use those times. All right, so we have our beginning of our shaded area when we're looking for bullishness as defined in the first part of this presentation. And I want you to look at how price moves running out previous day's highs. Okay, and here's a previous day's high right here. And I'm going to try to do this as quick as I possibly can and keep things moving along. But the high on this particular day here, you can see on the start of this candle here, it starts and immediately runs through a little bit. Doesn't go by much, but then it eventually trades through it here. That in itself, this little move here, that's actually a trade. It doesn't seem like much, it doesn't feel like much, but that's a trade. Now you're probably, because your eye's looking at it in the benefit of hindsight, you're going to look at this high and this move down and say, well, that's what I really want to capture. If you're going to think like that about everything I'm going to show you in these tutorials, I'm not going to be any help to you. Okay, because what you're going to be doing is trying to have perfection, and I can't promise, and I don't promise perfection at all. I do provide you resources that's going to help you get better at your price action analysis, and that's the only thing I promise. Okay, so we have a low here and a daily high, and the expectation is we want to see the high be ran out. We want to see the expectation of moving through this high. Why? Because there's going to be liquidity above that high. Why? I'm not going into it here. Just trust me. The banks make runs on previous days highs and lows, and if it's bullish, they're going to be targeting previous days highs. Okay, so the way we frame our setups is we use our fib. Okay, and we find the lowest bodied portion of the candle, and that's going to be this open here, and we drag that up to here. Okay, why it just jumped off the level I wanted to have it on. Sorry. I want it on this candle right here because it's going to be the highest body before this little retracement. Okay, and at this point we're going to be anticipating, because it only just briefly violated the previous day's high, we want to see a retracement. Our mind is waiting for it to trade lower. Okay, once it trades lower, we're going to be looking for it to go down into the optimal trade entry. Okay, that's our price pattern. It doesn't do it until after this little movement up. Now on a smaller time frame, we could probably see something in here that's an optimal trade entry, but I'm going to save that for volume 2. But in here, I'm giving you the big setups for your scalp setup. Okay, so using the hourly chart, we're going to see it here, and we're going to be targeting previous day's high. Now, on this day, when it trades down to here, we could be targeting a run back to previous day's high. And now what have we included? We have a higher high here in the same day. So intraday, we have a higher high, and we have previous day's high. Both of these conditions are candidates for a run on liquidity. Okay, so we have this one and we have this one. So as price trades down here, we want to anticipate a movement higher to run to this level, which it does here, and eventually back to this high here, which it doesn't do until this candle here. Notice that price trades down and the bodies of the candles respect the 79% retracement level. Okay, price rallies back up to this high. This is why I say you want to take profit, okay, at old highs and at your first scaling here. This is target 1. You can take profit there. Notice it never takes the high out yet. It has to retrace all the way back down to precisely the 79% retracement again, then rallies through, taking out intraday high, previous day's high, and again 2 days ago. Okay, this is your run on previous day's high liquidity. Now this candle on a daily basis, its high is here. Same scenario in here. It rallies up, takes out the high, which again we're going to have to see that on a lower time frame. We're not going to do it in this volume, but as it runs through, we want to see a retracement. Okay, we have the bodies of this run here. Why am I using this one? Because it's the most dynamic and recent rally, and we want to use it on the highest body open or close, which is here. Price trades down into the 62% retracement level right in here. We're going to be targeting previous day's high, which is here, and also now we have an intraday high here. So we have 2 reference points to look for. So we're going to anticipate the banks making a run on both of those levels. Initially, it's this one. Okay, so on the next day, it trades back down again, giving you another opportunity to go long. If you were trading here, you're outside of a kill zone. Okay, I want you to notice that every time that we create the signal and setup, if it overlaps with one of these colored levels, okay, or lines, that makes it high probability. If it's outside of one of those shaded time windows, it's less favorable. It doesn't mean it can't eventually move to profitability in your demo. It just means that it's far more likely to occur if it's occurring during one of these shaded time windows. Okay, so, and again, the blue one here is the New York kill zone, and the red one is London. So we have a setup here. It trades back down into optimal trade entry here, and it does so at the time of New York. Okay, so New York and London both have an opportunity to create a buying opportunity. London will give it to you that you probably got stopped out. Same scenario unfolds for New York. New York explodes, runs through previous day's high of 2 days before, and previous day's high here. Runs right through it. That's the trade, and it's over. It's done. There's nothing else to consider. There's nothing else to worry about. The trade is over. Okay, so now in here, we've had a couple examples. Nice little payouts, not barn burners, not grand slams, but bread and butter setups. Just using one pair in the course of inside of a week. We have nice little setups, and it's given us a really good opportunity to target a logical level, which is the previous day's high, and under the context of a retracement to a logical level, which is the fib, using a framework of bodies to bodies in terms of the swing highs and swing lows. And also, as a quick note, have this in your notepad, easy way to go for what swing high and what swing low I draw my fib from. I use session highs and session lows. So whatever the highest high and low was during London and or New York, I use those reference points. And then I just use the bodies, either the opener or close, whichever is the lowest for the low point of the fib, and the high point is whatever the highest is, the open or the close inside of the high. Okay. And that's all there is to it. Each new day, you're waiting for an opportunity for it to retrace back down into what would be otherwise the standard optimal trade entry, which is a 62% to 79% trade level, but targeting previous day's highs. Now notice once we hit this previous day's high here, the market goes into some of a consolidation. Now we do get a little bit of a run here, but not to the degree where we can really brag about it or go to great lengths to justify it. We do have a nice retracement here, okay, and I want you to take a look at that, because when we have a retracement of a day or so, that usually puts the cycle back in rotation. So we have retracement here, price comes back down to the 70.5 level, which is the sweet spot, OTE, okay, and it's happening at the time of New York, so that's a good scenario. We could see a buy there, but look at it, rolls over into the next day in London, it hits it again. So your stop would never have been hit, but you're holding on for a long period of time. So this is where it's going to stretch your patience as a scalper, which is the reason why I like being short term, because I know these are the conditions that's most likely going to happen. Hits the 62% retracement level, rather. And once it hits that in London, then it explodes. What's it reaching for? Previous day's high. It runs through that with no resistance whatsoever and blows through previous day's high back here. Okay, so really nice little opportunity there. And whenever you see a full day's down close, that's like a big red neon sign say, start following me, especially if you're in a bullish scenario. That market's primed to have an optimal trade entry long and start running out previous day's highs. Okay, on this one particular day here, price moves 30, 50, almost 70 pips or so. Okay, really, really quickly. And this is all mostly inside of 1 hour. Big explosive price move here, and that was seen on October 5th. And this continues on going through price action. And when we have scenarios that present themselves with the highest form of probability and not seeing any breakdown on the daily chart, it gives us framework, context, and specifics about what we're looking for, when we're looking for kill zone, what price level, optimal trade entry, what are we targeting, previous day's highs or the day before it. So yesterday's high or the day before yesterday's high. That's what we're targeting when we're bullish. Very, very simple approach. Nothing more to it than that. I'll amplify it in volume 2, and I'll wrap it up with a concise, more or less a trading plan in volume 3. Hopefully you found this insightful. Until next time, wish you good luck and good trading.